Portfolio Builder members, welcome to our Wednesday trade alert on the SPY ETF. We finally ended our losing streak on the SPY, and just real quickly I wanted to review 3 options for how to follow our program. If you have a $100,000 plus portfolio and you want to take advantage of all our trade alerts 5 days a week, this is the current recommendation. And again, each trade alert is just about a 2 to 5 minute trade right at noon Eastern, so you know exactly when it's going to hit and you know what the schedule is, as well as what the assets are that we're trading. Now, we're not recommending that you buy and hold the SPY, Facebook, or TLT outright because we're aggressively protecting those to the downside with put options beneath and selling call options above for income and to help finance the cost of the downside protection. Meanwhile, we do have a buy and hold portfolio that's currently holding GDX. Now, if you want to diversify that a little extra, I'll cover that later in the video, but this is our overall breakdown. You end up with either 100 shares of the SPY or 200 if you have a little extra cash. If you want to take the Tuesday trade, we're playing Facebook for most likely the next several weeks, and then a large position in the TLT, which has been our bread and butter all year long. Almost no losing periods on the TLT. That thing just broke into a new high today. Now we have another option. If you do not want to trade Facebook, then here's the breakdown of how we would allocate your capital. Again, the income trades would be Monday, Wednesday, Friday on the SPY. You need 100 shares of the SPY. For every 100 shares of the SPY, you should own 200 shares of the TLT. This gives you that equal weighting of bonds versus stocks. That simple little breakdown of allocations of capital makes it very hard to lose money in any given trading period. Now, my outlook, if you've been following, is that the emerging markets are crashing because China's economy is deteriorating. They've been the main buyer, the main source of growth in emerging markets. And so now we're seeing their yields go negative in the sovereign debt, and money is flowing into the dollar, the U.S. equity market, and the U.S. bond market, as well as into things like gold, silver, and cryptocurrencies. So we know we're inside of a huge bubble, and it's might be misleading to think that you can just buy and hold a lot of these assets and do well for a much longer time period. We're most likely getting towards the end of this new business cycle, and the reason the U.S. products are doing so well is not because of a global growth story, but rather a global crash story where money is just flooding into America as the last ditch hope. Now, if you do have a much smaller portfolio, or you just don't want to trade 3 times a week, this strategy works well to trade on Tuesdays, which is currently our Facebook play, and then 100 shares into the TLT keeps you very balanced and having a similar setup as the other options. But now you're only trading twice a week, 5 minutes at a time, and you'd still want to own some GDX. Again, that's the only buy and hold part of our strategy. The rest of the capital has put options below, call options above. This is helping finance our downside protection because we know we're in a very dangerous period of time where the main buyer of all these assets are not real people or real investors. It's primarily corporations buying back their own stock on debt that they've sold at super low interest rates. And so we're certainly in a bubble of epic proportions right now. Now, if you are getting this content delayed or you did not get today's trade alert, but you're seeing the live stream, that may be because your free trial has expired. So if you want to join us, call Dean at 505-322-7515, and we'll get into the details of that in a little bit. Let's jump into today's trade alert. Now, the profit quoted here is a little bit less than it is right now because we're trading above 288.39. Essentially, here is what happened over the previous trading period. The SPY went from 287.11 to 288.39 for a $1.28 gain when we closed out the trade. but our downside protection lost 95 cents. That's fine. We came out with a safe profit of $33 a contract, which may not seem like too much money, but if you did this 3 times a week, 52 weeks a year, that adds up to $5,148 a year of income versus a $30,000 capital investment to own 100 shares of the SPY. And that annualized is a 17% return. So we finally broke the losing streak on the SPY, and I'm expecting a rapid rally in equities. We'll go over all the big news, but the most important is that the bond market, which hit new highs today, is essentially forcing the Fed fund rate to either create systemic financial risk in the credit system, or they have to drop rates. And so the probabilities are getting higher and higher that rates will continue to drop lower and lower and lower, which makes it easy for banks to borrow money and invest it into the equities market. If you're only having to pay 1 or 2% a year in interest to borrow an unlimited amount of capital and throw it into either bonds to corporations who then turn around and buy their own stocks, or just buying the stocks outright, you can start to see why U.S. equities are starting to look very attractive to investors. Not to mention all the money that potentially is going to take profits in the long bonds and jump into the now sold off equities. So let's take a look at our various track records, how they all fit together, what our outlook is for this week, and then we'll jump into the big news. Now, if anybody has any questions, please let me know. We've got 12 people watching live right now, and you do have the ability to chat with me live. The price on today's trade alert has gotten a little more, well, I guess it's right about the same. We're trading right around the exact price where I took the screenshots. So if you are following today's trade alert, we have the potential to earn $3 a share per SPY, or $300 a contract, and the potential to lose up to $450 on the downside. Now, I think we have sidestepped the majority of the down move, and I'm looking to see some profit taking on the bond portfolios and then reallocation into equities. So we'll take a closer look at that. But meanwhile, our Thursday portfolio is almost taking the lead against our very aggressive Tuesday play. It's outperforming our SPY program considerably, but as I've said, typically one goes up, the other lags behind, then the other goes up, and the other lags behind. So I would suspect, since we just had an epic run in our Thursday trade alerts, pushing the profit to 13.9, and that is after we have to cover our short call option on the TLT. So we've been actually missing out on a lot of the profits on the Thursday trade by being so conservative, and we're still up 13.9% in that portfolio today. Let's just take a look at each portfolio really quickly, and we'll look at our outlook. So the big picture is that shaping up that there's really only going to be 3 smart options to invest large sums of capital in the foreseeable future. Number 1 is obviously into the U.S. Treasury market. We now represent 95% of positive yielding bond yields. So if you have to park cash into bonds, or you're going to go into a negative yielding country like Germany, where you're guaranteed to lose money if you hang on to that bond, and you're really just gambling that things are going to get much worse so you can flip it for a profit, or you're going to go over to the U.S. Treasury market where you can still get a positive yield. So that's definitely a very attractive product, and why we've seen tons of funds flowing. I'll pull up that track record here. And again, in our daily email, you do have access to this. Now, I put that we had a sell at 145.50. That's because we sold the short call there. It's trading at 148. If we had not been so conservative about how we're trading this portfolio, we would have been up a couple extra percent today. But that's not the goal of this program. We're trying to consistently generate profits. with as little risk as possible. So we also had to let our put option expire worthless on this, and this will be closed out tomorrow. Just giving you a heads up of what's coming up for our Thursday play. Meanwhile, this call option on gold is up considerably. It's not actually closed out. I just wanted to put that up there so we could see a real-time calculation on it. Let me pull that up. So you can see it's still trading right around that price, up 250%. So that was a nice play. And again, this is our Thursday portfolio. It represents 40% of our total capital. So if I go back to the summary, again, you can see I have 40% of my total portfolio playing the bond market on Thursdays. Now, the level the TLT has risen to is quite frankly unbelievable. A lot of the bond kings out there, like Jeffrey Gundlach, PIMCO, most of the big bond managers have been skeptical of this rally and how low rates can go. So we'll jump into that in a little bit. My expectation is that yields will bounce around this area for the next several weeks and maybe even sell off as the Fed is most likely looking to just drop 25 basis points in September and another 25 basis points in October. So if that's the case, I think that it will be enough ammunition to keep the bond market maybe from crashing, but perhaps not rallying any further and push a lot of capital into the equities. So really, we have China devaluing their currency, which is causing all the surrounding countries to have to do the same. And when you think about it, if they're going to devalue their currency, print a bunch of money, that makes the relative value of dollars, U.S. equities, and U.S. bonds more and more valuable. So at the current point, having this balanced portfolio makes a lot of sense and makes our life pretty simple. So let's take a look at the SPY program. And I'll double check, see if we have any questions out there yet. No questions yet. So SPY program has had a little bit of drawdown over the past several trading periods, and that's because Trump came out with the increase in tariffs, and that created a pretty nasty sell-off in the market. I do think that the rhetoric will slow down for a considerable time now, until Trump loses even more patience, as it seems like the Chinese are simply going to devalue their currency and really just try to ignore all his threats and continue doing what they're doing. So that's our current setup on this trade. And today's trade alert will benefit if the SPY travels higher and has a potential to earn up to $3 a share or $300 a contract. That's a lot more than we normally aim for, but because of this sudden sell-off and the big picture shaping up that there's going to be essentially free money around the world with currencies being devalued, I'm expecting a ton of capital to flow into the SPY to close out the year most likely. Now the catch is the trade war news is extremely sensitive in the markets, and so that could create some more volatility for us. But for now, the picture does seem to me to point to the SPY climbing back to 300 and beyond. And so at that point, we'll stop having such bullish trades once we get to that 300 range and start trading in a more flat strategy. So we'll be selling those closer to the money covered calls and then buying further down puts. All right, let's look at the big news. And then we will wrap this up and get ready for our webinar coming up for paid members in about 40 minutes. Now, don't forget, we do have a live webinar where we can actually chat out loud together tomorrow, Thursday at 1 Eastern for our non-paid members. Okay, so here's a quick look. Trade alert headline today was doom and gloom, clouds over America. We got the Treasury yield hitting below 2, first time in history. And the big picture continues to develop just as we said. Here's a look at the SPY bouncing around in this area over the past month. It's made it a little bit difficult to generate a profit on the SPY. We can look at our monthly return on the SPY program specifically. And I do want to point out, when you have overlapped our strategies together, we only have one losing month in July for -1%, and August is actually shaping up to be a better than normal return at 1.7. SPY program has had a little bit of a bumpy road the last few months. I've been concerned that the trade war would escalate since June, and so we took a loss in July, being ultra bearish on the SPY and having to watch the SPY climb up to new highs. And then right when we thought the trade war was going to be just kicked down the road to 2020, Trump decided to come out and re-escalate. And so despite all of that, we walked away so far just on the SPY program with only a -0.1% return. And I would suspect September, October, November, December should be pretty easy trading until we get back into all-time highs. And that's when I would suspect Trump will have the courage to go ruffle up some feathers once again. Okay, so that's the SPY portfolio. Equities portfolio 2 is simply taking the best assets that are held in the SPY, looking at what's the best deal in terms of selling a covered call, buying a put, and then trying to generate consistent income. And so we've had some pretty wild swings in this portfolio. The biggest return was 7.7 in January. We also had a nice 6% return in June. And so this portfolio will take a lot greater risk because it does manage a smaller position and it's trading a specific stock. Currently, I really like Facebook for this trade, and that's because it's really separated from the U.S.-China trade war in terms of the economics of its business. It's relatively young, and it has certainly a monopoly that's going to be very difficult to break up. So I like what Facebook has from that point of view. I think they will have record profits in Q4. And at the same time, they are trying to solve the big problem of the current decade, which is central banks getting out of control, printing way too much money, bailing out the banks who've made stupid loans and really ripped off the populations around the world. And so now we're starting to see inflation pick up in everything. Now, of course, they try to hide that inflation number in every way they can, but that's the big picture. And Facebook has a solution called Libra, which, if approved, could be absolutely huge and push its market cap from the current 500 billion much higher. It would help them take this huge user base and start really increasing the profits from each user. Our precious metals portfolio has done very well. The best return was in May, a 60% gain. And this started off in December with a relatively small position, 2.5%. And that's because the Fed was saying they're going to raise rates all year and that this quantitative tightening was on autopilot. Stock market hated that, crashed pretty heavy. And by February, the Fed was going to stop the quantitative tightening sooner and stop raising rates. And then, as we've seen in July, they finally started cutting rates. And now I'd expect they will continue to cut rates for the foreseeable future and start buying up treasuries. We already saw them buy some 10-year treasuries in the latest report. Possibly what they're trying to do is fix the yield curve. Not quite sure because they didn't really mention anything about starting up QE yet, so it was interesting to see that pop up in their latest data. This portfolio has now risen to a 10% total portfolio position and is primarily focused on GDX. Now, I do like Bitcoin and Ethereum. So in our portfolio, we have 7.5% in GDX, and then 1.25% in Bitcoin and 1.25% in Ethereum. For a lot of people that don't want to mess with crypto, we just recommend going all in on GDX, or you could replace some of those cryptos with the silver miner ETF SIL. So we'll cover that in a little more detail in a minute. The bond portfolio has really been our bread and butter. 2.2% in December, and then around 1% for each month the rest of the year, outside of February, which is kind of funny because that's the month where the Fed actually started to talk about lowering rates, and that's the 1 month we had a loss on the TLT program. And so I'm starting to think we'll be a little more bearish on the trade alerts on the TLT during the next several months as we start to see if the equities are really going to rally and if that can push up the potential yield on these bonds just a little bit. So not sure we'll be betting up on the TLT in the next trade alert after seeing this tremendous rally, and most likely time for some profit taking. And now I will go into our live stream and we can take a look at the most important charts and how this is all shaping up. So here's that SPY. And again, if we go back to the December crash, this was facing a period of time where the bond market yield was actually so attractive that it was pulling money out of the stocks. I think we got up to something like 3% yield. And when you can get a guaranteed 3% yield for 10 years, that's going to pull a lot of attention out of equities. Now we have the opposite story. So I do suspect that we're not going to have a repeat of that December crash anytime soon, because there's just so much money out there with nowhere to go. There's nowhere to find some sort of yield unless you're just speculating that this bond market's going to keep crashing the yields lower and lower and push the bond prices higher. So you get a lot of people who are buying sovereign debt with negative yields as a insurance play in case things go south, that they can flip those bonds. Now, who's going to buy those negative yielding bonds if they go lower and lower? Well, they're expecting the government will have to buy those to support their credit market. So quite crazy. Here's the TLT hitting 148. So you can see just in the past month, it has had a tremendous rise from 131.50 to 148. And so I don't think the run is over for the TLT. I think it will go much higher if this drama between the U.S. and China extends, which it almost certainly will. And we'll take a look at some forecasts for China and what's going on with their underlying economy in a minute. But I am suspecting potentially a little bit of profit taking on the TLT. I don't think the yield's going to really dramatically go up, but I do think that this has overshot, and this plays in well with the SPY taking off. Here's a look at that chart on the TLT over a longer time period, 5 years. And you can just see how extreme these bond prices are. LQD is the investment grade bond ETF. And this has been one heck of a chart as well. If we look at that 1 year chart, smooth sailing. This is what's funding the primary buyer of the equity market. So imagine if you can borrow money for nearly free in the corporate bond market as a corporation and then turn around and buy your own stock. So until this ETF really cracks, it would appear that the cycle of having corporations buying back their own stocks will not come to an end. This is Stanley Druckenmiller's favorite indicator for the real health of the stock market, the Russell 2000. And so it's been teetering on this support line right here. I do suspect that it will break to the upside as well, and I am expecting that unless we really see some major strings pulled on the U.S.-China trade war to escalate, that this will strengthen and support a very strong rally. We really have nowhere else in the world for people to invest, so that's why I think we will continue to see this bubble expand. GDX is now our core recommendation for the buy and hold portfolio. We were in GLD, that's the spot price of gold. Problem with the spot price of gold is the central banks can really control that rate if they start to load up on that. But what they won't really touch are the gold mining stocks. So the central bank may manipulate and suppress the value of gold so they can accumulate it in the event that they need to have some sort of gold standard to back their assets, or at least the credibility of their central bank. But what they're not going to really mess with are these little mining companies. And so GDX gives you great exposure to the actual miners. And the only reason we'd want to own GDX is if we believe there is a considerable long-term increase in demand for gold, which with the given conditions, I think is the case. Now, if there is a de-escalation in the China trade war, the primary thing I'm watching out for would be news that Chinese are going to start purchasing U.S. agriculture. If that's the case, we might see a break in the trade war escalation. We might see these bond prices really sell off considerably, and potentially even a sell-off in gold. Good news for us right now is it does not look like that's the case. So seems like just the overall slow growth of the bubble will continue for now. And so our recommendations remain the same. To give a feeling for how high these GDX ETFs can go, easily to the 66 level from the current price at 30. And the run up from here was caused by all the money printing from 2008 through 2010, when Obama came in and bailed out all the banks who had underwritten all of the bad mortgages. Here's a look at Facebook. This is our Tuesday play. Shaping up for a very nice rally if we get the overall market direction right. So this is what we're looking at on our Tuesday play. Potentially a good leading indicator for trying to predict stock market trouble are two things. One is stocks in China, which continue to remain quite strong so far. I'm a little bit surprised on that. Also keeping a close eye on the two big banks in Europe, Deutsche Bank and HSBC. If Deutsche Bank gets below 6, a lot of people speculate that it could go insolvent and create credit risk for all the banks. Another interesting development on the HSBC story is that they were the ones funding and supporting the Chinese currency, and a bunch of people got fired recently, and supposedly that relationship has ended. So at the same time, we're seeing the Chinese starting to lose control of their currency exchange rate. As far as trying to predict where capital will flow in terms of investments, I'm looking at two main currencies and their relative value against the dollar. So the euro devaluing, and this is just over the last 3 days, and then the Chinese currency devaluing. So again, if this chart's going downward, it's the euro against the dollar. That means the dollar's getting stronger. On this one, it's the dollar against the Chinese currency, and you can see they've been not escalating it right now. But if we do go to the next chart, you can see over the past 1 month, it has gone from 6.9 conversion to 7.16. So they are certainly devaluing their currency, which is causing the rest of the world to devalue their currency, which is making their ability to pay off debts, which are always denominated in dollars, to become more and more expensive. So what do? They print money to pay for the interest, and this is increasing the overall global money supply, but they have nowhere safe to invest. They have the insurance play, buying the sovereign debt that's negative yielding, and then they need to look at equities options Well, most of the big companies you can invest in overseas are just banks, and the banks are suffering from this low interest world we're living in. So this is pointing to me as a huge bullish push into U.S. equities ahead, outside of the trade war really escalating. And here's a longer look at the 6-month view. Now, if the Chinese really want to become a global power and try to take away the prestige of the dollar, they're going to have to make their currency appear valuable. And the whole thing about China is that it's a closed system. Money comes in, but it never goes out. And so it's very hard for anyone to get money out of China. The Communist Party funnels it through their Bank of China and through Hong Kong into everything except Chinese products. So we'll take a look at it. Interview. Here's the government bond for the Germans. 10-year negative yielding. So you're actually paying the Germans for the right to lend them money. It makes no sense. The only reason people are buying this is it's an insurance play to back up their equities. If the equities crash, then money's going to flood into these bonds with the expectation that the German central bank will have to protect that bond market and let you cash out for a profit. So it makes no sense, but this is the world we live in. And until things start to crack, the money supply will continue to expand, and I think we'll see a lot of cash floating into U.S. equities. Here's our 30-year yield, just collapsing. Put it into a bigger picture. This 2015 crash in yields was due to a China slowdown, and then they came in with a huge amount of stimulus to build up their housing sector and to do this Belt and Road Initiative. But it appears the Chinese are out of credit. We've come in and put pressure on them at the worst possible time as their economy was already slowing down rapidly. And here's a look at the Kospi. This is the South Korean stock market. So you can see it is struggling for over a year and a half now, and just shows the trouble worldwide from China's massive slowdown in growth and its credit expansion coming to potentially an end. Keeping a close eye on oil. If it gets too cheap, that signals that growth demand is just completely puttered out. On the other hand, if it gets too expensive, that pushes inflationary pressures into the economy, which would make the banks raise rates, which would make everything crash as well. So no alarms there. It's sitting at 60. Silver is taking off above 18 now, playing the same move as gold. Some Trump tweets. Really, the only Twitter account you need to follow in this day of age is Trump's. Let's see what he had to say today. He is very upset with the Federal Reserve. The Federal Reserve cannot mentally keep up with the competition. Other countries at the G7 in France, all of the other leaders were giddy about how low their interest costs have gone. Germany is actually getting paid to borrow money. 0 interest plus, no clue from the Fed. So interesting to read and see all of the free and interesting advice I'm getting on China from people who've tried to handle it before and failed miserably. In fact, they got taken to the cleaners. We were doing very well with China. This has never happened to them before. Kyle Bass has really been leading the march on trying to educate the world about China. Interesting Twitter to follow on top of Trump's. Italy is too big to fail and yet too big to be saved at over $4 trillion of debt. It's the first of its kind globally that doesn't have its own central bank to buy its bonds at will. This identity will likely cause another Eurozone crisis in the next few years. Here is, I'm not sure how accurate all this is. I guess it's from Wall Street Journal, showing that households have bought 22 cents compared to corporations buying $2.45. of stocks over the past 4 years. That's absolutely insanity and gives you an idea of how manipulated these markets are. And again, that's why, despite our belief in these assets being in a bubble and rising over the next several months, maybe even years, we want to have those put options below. We recognize there's extreme risk of this house of cards coming down on itself. If China was dominantly a consumer economy, it would not allow the yuan to depreciate so much. Forex action confirms that China remains predominantly an export-led and puts most of its economic data in question. Now, one thing that definitely concerns me would be if the Fed were politically motivated to create a recession to try to get Trump out. You got to realize the Fed is not some sort of completely government-ran independent bank. It's really controlled and managed by its smaller set of banks, which are owned by people like Goldman Sachs, JP Morgan, and they're really the ones running the show. They have people buried throughout the government. It's really insane how tight it is together. And the banks are now in cahoots with the Chinese. If you think about who's the biggest investor of all these banks now, it's the Chinese Communist Party. And so China has some $12 trillion GDP per year, and they take about 90% of that and run it up to the top of their CCP, their party. So they have tremendous capital that they have been lending to these American banks, and the banks really want to see, do not want to see what's happening to China because they have so much money from the Chinese. Okay, the big bond kings have not been buying this rally to bond prices this high. 3 bond kings, PIMCO, Gunlack, and Guggenheim's, all underperforming 90% of their peers, must be a first. If you've been listening to Jeffrey Gunlack, he's actually been predicting that yields would rise this year. So he's been having a tough year with a lot of his predictions. The last several years, he was extremely accurate. So definitely good to keep a close eye on his Twitter account as well. This guy used to work over for Ray Dalio. Bond yields reflect sentiment, not reality. PMI and all other measures of sentiment are reflecting high levels of uncertainty. Hard data is weak, but an order of magnitude better than the sentiment. Even in Germany, data is barely negative. GDP is largely unchanged in the U.S., which is also what I'm seeing, which points to potentially quite a breakout ahead in the SPY. The Chinese protests, or rather the Hong Kong protests regarding the Chinese extradition bill continues to escalate. Something very important to follow, and potentially could be the black swan. No one's really expecting what would happen if there is bloodshed in Hong Kong. Would this be what really takes the U.S.-China relationship to a whole new level in terms of tensions? So that's something that's very interesting. Chinese are saying that the U.S. has their black hand and has been trying to incite these protests. And what's bigger about this is it's showing to the Chinese people that the Chinese Communist Party can be stood up against. And so that is their biggest risk and their biggest concern. So this is a huge problem for China. And so we're definitely keeping a close eye on that. China continues to talk big game about not giving in to any pressures from U.S. We'll get to a little more of the inside scoop on China in a minute. Norway is buying up tech giants. We're going to see, I believe, all these huge central banks around the world who can buy stocks starting to take some profits on their bonds and flood into U.S. equities. So we're positioned very well for that currently. Now, in my Tuesday trade, I'm happy to play Facebook right now while prices are relatively sold off and cheap. Once we get to 300 on the SPY or so, I will take a lot of risk out of the Tuesday trade most likely and buy the safer asset of Microsoft. So whenever we do get the next trade war escalation, assuming we do rack up some gains in our equities portfolio, I want to own on the Tuesday play something a little less crazy. So we'll either have Microsoft or silver on the Tuesday play after we see the SPY get towards that 300 level. So Facebook will ride up for a nice big gain over the next several weeks. Once we get towards the 300 mark, I'll probably rotate us into Microsoft. And then once we get really, really overbought on equities, probably rotate back into silver, expecting Trump or China to retaliate and create more tensions. The Federal Reserve loves watching our manufacturers struggle with their exports to benefit the other parts of the world. Has anyone looked at what almost all other countries are doing to take advantage of the good old USA? Fed has been calling it wrong for too long. Now, this is the only YouTube video I left you guys for today's live stream. This is a billionaire who got out of China, has a lot of wild accusations. Even Kyle Bass says he has a hard time believing half of it. But a lot of his predictions have been coming true. And just to summarize what I got out of it, number one, he has an interesting prediction, spoiler alert, that Jack Ma, the owner of Alibaba, will have to give up the company to the Communist Party or will end up in jail or dead. And this seems to be the case for anyone who comes up and creates a super profitable company in China. They have to give it over to the Chinese Communist Party. If they don't, they end up in jail or disappear. So that's one. Two, he believes that the Chinese economy is crashing and that this pressure will take them out within the next 2 years. And that the key thing to look at is the currency conversion rate. Goes into a lot of details about how the Communist Party uses their bank to take money out of China. They don't allow their people to do this, but the super rich who control 90% of the wealth, which is less than 1% of the Chinese population, they are trying to smuggle their profits of China out of China and have been buying up things like real estate in Canada, in New York, all over the world. And so the biggest problem for the Communist Party is that they really take advantage of their people. And now they're seeing revolts in Hong Kong and Taiwan. And this is potentially giving people in China the courage to stand up to their government. So that's the big picture here. And yeah, let's see if we got any questions out there, you guys. We got 20 people watching right now, so that's the most we've had live. Any questions, guys? We do have our paid member webinar coming up in a few minutes, and then we have a freebie webinar tomorrow, so hopefully people can make it to that. If you're getting this content late because you're in an expired trial, call Dean 505-322-7515. We can upgrade your account and get you all the trade alerts real time. Our goal is to protect your capital, to generate consistent retirement income, and to get around a 1% to 2% return per month with extremely low risk. So we've been doing a good job at that. Our audience is growing by the day, and we really appreciate everybody's time. Any chats out there that people want to? Our audience has been growing the longer the webinar's been going. So make sure to remember to subscribe to the channel and click that little bell. That way you'll automatically get the notifications of our daily live stream. And so obviously I do reveal the big macro trade alerts, what the ideas are, what I'm expecting for free in this daily webinar. What you don't get is the actual options trades surrounding the asset that day. So that is exclusive to our paid group, but I do think our free content each day does provide a lot of value all on its own. So I'll show you guys the link to get that. If you click the subscribe button below the video and then click that little bell, make sure the little bell is marked and you get our daily live stream. Okay, we got a question from Patricia. So what direction do you see Baba going? Okay, so currently we have a put option on Alibaba, and one of our portfolios more as a hedge. And so I'm holding on to that. We got rid of some of our put options on FXI during the crash, or the immediate tariffs rising. We weren't able to get rid of all of them, and still are holding some. So I do think the US market and the Chinese market will go up and down together. So those may not pay out for us, but if the trade war escalates sooner than we expect, we'll be glad we own that little put option on that. Now eventually I do think the Chinese economy is going to crash, and we'll see how much pain it has relative to the US equities market, but I don't think we're there yet. And the key thing to watch out for a major crash would be the currency devaluing. Any other questions out there? There's a live chat box if you guys want to ask any questions. Please feel free to do so. All right, guys. Well, thank you so much for your time. We had up to 20 people live today, so it's growing. And we've got our paid membership webinar coming up in 5 minutes, so I better get off this and jump onto the next Zoom. Thanks again.